Hello again. Welcome back to the Money Corner. Tonight we're going to talk about history. I've got two guests who have many, many decades of experience on Wall Street. They don't look like they're old enough to have decades, but Carl Antenucci, my colleague of mine from Merrill Lynch, has been on Wall Street since 1954, is it, Carl?
Correct.
Bob Rittereiser has been on Wall Street since 1958. Both these gentlemen are Bergen County residents, by the way. But both gentlemen, Carl has been a major executive in Merrill Lynch in several different areas, and Bob has had a very distinguished career, most recently as president and chief executive officer of E.F. Hutton and Company.
Right.
I got the initials right,
That's
too.
correct.
I'm batting 1,000
there you
right
go.
now. Fellas, in anticipation of this, and I said when I recruited you for the program that we would take a look at Wall Street, where it's been, where it is now, and where it's going. I guess we're talking about more in Wall Street. We're talking about the entire future of the United States and the Western world. I did a little chronology in anticipation of the program and tried to pick out some major events that I think are significant and have had impact. Remember the Eisenhower heart attack when you first got in the business. Remember Kennedy had a confrontation with the steel companies. We had a major market break in May of '62, probably one of the most severe, and everybody anticipated the Great Recession, which never took place. In November of '63, the market closed down for 2 days when Kennedy was assassinated. Closed down by 2 o'clock in the afternoon on a Friday, opened Tuesday morning, and opened very strongly, by the way. We've had events like major firms closing down, McDonald, Goodbody,
Right.
DuPont, Lehman, and then Bob, I guess with some regret, your firm, Hutton, either closing down or being merged out of business.
Right.
1966, the Dow hit 1,000. 1973 to 74, we had a bear market with OPEC, the oil problems. 1987, the Dow hit 2,000. Then August 87 through October 87, the market dropped 1,000 points and 35% in about 3 months. 1990, the Dow hit an all-time high of 2935. The Carter years, inflation, I guess the prime got as high as 16%. I would think that's a number we could peg on.
Yeah.
1977 to 1980, gold climbed from $35 to $800 an ounce. The Reagan years, Volcker, the recession, tax cuts, the deficits, a bull market that started in 1982 and is still in existence. Now the 80s, the leveraged buyouts, the buybacks of corporate equity, program trading, and I guess the bailout for the savings and loan. Now, we could write, volumes could be written about this.
Yes.
And I guess what we're really asking ourselves now, everybody on the street, where have we been, where are we going, and what do you fellas see as you look at both the markets and the structure of the industry?
Well, perhaps I'll just start a little bit by just reminding us that in that same period of time, in 1975, the Securities Act was also changed so that competitive rates and a competitive environment was created. It used to be fixed commissions, and really an association operated the financial markets when you get down to it. And that was a so-called beginning of the competitive era, but that competitive era didn't really become very competitive, I don't believe, until Regulation Q in the Federal Reserve was changed, which allowed banks to alter their interest rates on their products. So I think the 1980s have only really begun what amounts to a competitive era in financial services as well, and brought about, because of the changes in interest rate, the focus on interest rates and interest rate related products has created a much more complex environment as well in the last 10 years, and I think that has been another very important change that I really think is worth mentioning, because that's what a lot of people are trying to deal with, returns on their money.
I want to pick up the element of complex environment, but before I do that, Carl, how do you see the same era that Bob just talked about?
Well, I see it the same as Bob does, but as a major corollary of that was the dramatic change from the individuality that was a major part of the market years ago, when I think approximately in the 60s, 90% of the volume was individually oriented.
Right.
That was the individual investor.
Individual investor.
Or the small investor.
Right.
Whereas today, I don't know that anybody has a real handle on how it has become so institutionalized, but most people feel it is in the area of 80 to 90% of the transactions now are institutional. So this is a very, very dramatic change, and the volatility and so forth that's going on with the derivative products, program trading, it's all part and parcel of the major adjustment that we've seen, that Bob has alluded to, and that you've alluded to. And I think that, as you indicate, the period of the 90s is going to see as much, if not even more change.
Well, fellas,
as we move forward.
I said to you, you can take our program tonight and our content whatever direction you want, but you have to keep in mind that the people watching this program are essentially small investors, if you will. Not necessarily small. Some of them have significant amounts of capital, but they really have to worry about college tuition. They have to worry about retirement. They have to worry about protection against inflation or deflation. How does that institutionalization of the environment impact or translate back to the average man or woman watching the show tonight?
Well, one of the things, and Bob will comment on it after I speak, but one of the things that's happened is the individual is still in the market, but he's in the market in a different way. The individual is now investing his funds, most of them that I think are through the mutual fund environment and so forth. They're going to institutions for professional advice more and more. In the old days, they used to depend more and more on research that was produced by firms like the ones that we work for, and I think that still is a factor in the market, and it's a sizable factor, but I think institutionalization has now become so important that even the individual feels that he has difficulty in many cases performing as well as some of the professional institutions can perform for him. And I think as we get into this discussion, there's a lot of reasons why I think you'll continue to see this trend in the 1990s.
Bob, go ahead.
Well, first of all, small investor, large investor, people's money is always important to them, and it's always big in their mind, and they do want to be treated. They want to be able to participate in the markets. They want to be doing as well as they can be doing financially. So the consumer is at the point where all of these factors have frightened them, and they have moved to a lot of the vehicles, as Carl points out, the funds. I think they still would like the financial institutions to continue to serve them, however. In fact, I know they do, with good advice, hand-holding, guidance, reinforcement of the kind of information that they themselves are gathering. They're having difficulty sorting out all this information. So to a great extent, the challenge, I think, for financial institutions going forward is how to structure their own relationships with their customers so that they can do a good job in this area. I think customers do want to do as well as the markets overall. They want to be in the right vehicles. If new products come along that do make sense, A, they want to understand them, B, they want them to meet the basic need that they're described to meet, and they want to be able to understand them well enough and be informed and educated. And the real challenge for the brokers and for banks and others who wish to compete with the brokerage firms that traditionally did this work and the money managers is how to cross that line in the years ahead and serve the consumer in that regard.
I met you. All right, Carl, go ahead.
By the way, having said what I said before, I might say that one of my visions of the 90s is that we're going to have the cycle come full turn, and that the individual is going to come back significantly in the marketplace somewhere along in the period of the 90s. And we can get into the reasons for that, as we move along here. But one of the things that I think that the 80s was known for were excesses. There are a lot of excesses. The debt, situation, the taxation situation, the Reagan tax period where taxes dropped like a rock. Now you've got a situation changing where, for instance, let's take capital gains. Capital gains on ordinary on transactions is the same as ordinary income taxes. The incentive for the little guy to make money in the market in that regard is not as strong as it used to be when the capital gains tax gave you a great advantage over the regular tax. Now, I'm not a prognosticator of what politicians are going to do in Washington. That's harder to read than the stock market, for instance. But I do feel we're going to see major changes in the tax structure as we move ahead. And you've already started to see the beginnings of this when Bush has indicated that he's ready to have revenue tax changes.
His lips were unsealed.
Exactly right.
Yeah.
Exactly right. And I think what's going to happen, and you've already seen what I consider personally a trial balloon go out on a transactions charge, which I happen to personally think, I don't know how Bob feels about it, but I happen to think that that would not be a very good tax to put on. I think it'll hurt the liquidity of the market. You know, people say, well, program trading and this and that, but I think it'll hurt the liquidity of the market. I would rather see a capital gains tax reduction that will incent people to take longer term gains. And I think that that will be one of the steps to get the little guy back into the market. And I think it's going to happen. Real estate, by the way, as we all know, and especially us in New Jersey, real estate is having a difficult time. And the idea of buying a house as an investment and seeing that investment grow over the years is getting less, belief in the street, because people are seeing the housing prices stabilize, if not slip. And one of the points I'm trying to make is that people are going to have to look for another place to go to beat the inflation. And if people start to save more, that's another change I see from the 80s. In the 80s, you had people spending. The consumer was a major spender. And our savings rate as a nation were among the lowest in the world. I think you're going to see savings rates start to increase. And people are going to be looking for places and vehicles for the use of their money. Now, if houses are not going to be as attractive as they were, and that's just a personal view, but I don't think they will be for a while. If the economy starts to slow down and if we increase taxes, it's going to hurt the economy. The economy is going to continue to stay slow. If that's the case, where are people going to put their savings? And I think with a lower capital gains tax, you could see an incentive along the way for people to start putting their money as the 90s move along into the equities market in some form or another. And I don't know if Bob agrees with that.
Well, Bob, I don't know what point you want to come in. I want to toss a question out at you, and you can either respond to me or go back to take the direction you want. We met at a social event about 3 months ago, 4 months ago. You made a very casual comment to me. You said when you were in office, before your firm had been merged, you ordered a survey, in effect.
Right.
Because you weren't satisfied with what your people were telling you, and you didn't feel that they really had a handle on where the consumer was. Would you elaborate? Is that
sure? No, you're absolutely right. I was operating on there's an old saying that I think it's Artemus Ward once said, "It isn't what you don't know that hurts you, it's what you do know that's wrong." And I think a lot of people were operating on assumptions about what the consumer wanted from the securities industry that I believe might have been misdirected or misguided, and had some attitudes toward the way to serve the consumer that I believe needed to be changed. And but before I went off with my own half-baked idea, I thought I ought to check it. So we did a very extensive study of investors all across America, and some of the highlights of it were quite interesting to us. The consumer, the investor had very strong belief that he needed assistance from a human being who was spending a full time studying the markets and able to work with competence and integrity on their behalf in terms of helping them monitor their money. So
a true professional.
And they're very astute. They knew that they wanted experienced people. They wanted some of the qualities they looked for included the ability to teach. They wanted the relationship to be one where after the conversation was over, even if the person walked away with simple confirmation of their own thought, they wanted the feeling that they had increased their own education in the process. And they were willing to pay for that service. It was not, they weren't so interested in running off to execution-only low-price brokers. They wanted something of value in that transaction, and they knew what they were looking for. On the other hand, they were not as worried about whether or not they had the exact right product with the 1400th decimal point figured out correctly. They wanted products that were easily understandable and products that really met what they said were their objectives. And they wanted those products to basically be designed that way. So it implied to me an opportunity for firms to carefully manage their product design and to manage the way they deliver their product. And I think, in touching on what Carl said, the return of the individual investor, I think there's a tremendous opportunity out there now for financial institutions to sit down and figure out how to do that task well in the 1990s.
Well, we're going to have a tremendous challenge as an industry because, and Bob, of course, has a lot more experience in this than I do, but there is a revolution going on in the industry itself. We're talking about the individual investor, and then how about the vehicles that supply them with the services? And I do think that we're going through an obvious dramatic change in our industry in terms of its structure, where it is, and where it may be in the next 5 to 10 years. And my own feeling is that we're going to see further restructuring. My own feeling is that we haven't gone full cycle yet in terms of readjusting to the cost realities of the day. And
restructuring is a very general kind of word, which is almost jargon. What do you mean by restructure? What is going to be restructured?
well,
I'll offer an opinion on
Go ahead,
that.
Bob.
Okay. I think that a couple of things. First of all, there is a huge overhead in terms of data processing and the facilities to execute.
That's the cost angle from the viewpoint of the corporate, of the deliverer of service.
Right, the deliverer of services, whether it be a bank or a brokerage firm, there are huge costs in data processing, information gathering, information reporting, information
That's
servicing.
the overhead. That's the cost of doing business.
It is the overhead, and it's become very complex and very costly. More of those services are going to have to be purchased from other providers of those services rather than made from in-house and built from within each firm. I think there's a major restructuring of the exchange structure, the clearing structure, the processing structure still to come.
Bob, just by way of helping our audience,
Sure.
they have not worked at your level.
Right.
Let's talk about brokerage firm A or major money center bank A. Just
Right.
elaborate a little specifically. Who are these who are these service providers?
Well, the service providers would be companies such as telecommunications companies or data processing companies.
Are you talking about preparing statements?
Preparing statements, but doing billing, doing the processing, operating telecommunications networks. A lot of the things that are currently
In-house.
done in-house
Will now go out of house.
will now go out of house, and they'll still, with the kind of technology that exists today, they can still be customized from firm to firm. But the real competitive advantage will have to come not so much from the simple delivery of those basic services, but from what products are you offering, what is your competitive advantage as not only in your products, but I think particularly the way they're marketed, the way they're presented, the way they're explained to the customer. And that's where the role or the marriage of personal services from either service providers or account executives and market professionals linked with new service structures and new product structures. I believe most of Wall Street cannot afford their own existing product structure that they have today.
You know, it's interesting, but the real heyday then could be for the guys like me who are experienced money conveyors of information to the consumer about money.
I don't think there's any question that the opportunity for a truly competent, experienced, knowledgeable advisor to individual investors, that there's a great opportunity there over the next decade. I think it's a great place to be. I think there are a lot of people not up to the task, quite frankly, do not have the experience, and are hurting the industry. And I think the banks have a very difficult time of figuring how are they going to perform that function. But they better learn how to do that, because
they have a problem. They can't afford to pay the people to get that level of skill.
Well, they may have to. They may have to figure out how to do it. I don't necessarily think they have to do it necessarily the way the brokers do it today, but they're going to have to put together some combination of information services, bookkeeping services, and advisory services that meet the customer's needs. Or they're going to lose those customers, many of whom are reaching that stage in life where they're beginning to accumulate discretionary funds for investment.
I want to bring, Carl, go
Well,
ahead.
just to comment on this very question, and looking at it in a broader context, is that when you look at some of the largest banks, not just in the country but in the world, the Japanese and German banks, they have a more open society than our banks do. Our banks are constrained by Glass-Steagall, et cetera. And as part of this transition into the 90s, and as part of the change and the requirement for capital and all these expenditures that Bob's referring to, just one man's opinion is that you're going to see further consolidations and potentially
Are you talking about further consolidations of banks now, specifically?
consolidations of financial services.
Because the consolidation in the brokerage industry has been fantastic. We have come from hundreds of firms down to perhaps now, we may be down as few as 40 significant firms in the United States. Bob, you might have a better handle on that number.
I'm sure the number, I'm confident of this number, that 75% of the business probably goes through probably the top 20 firms.
Okay.
But I would also tell you that the number of registered representatives has not declined significantly.
So there's going to be a shakeout there.
Well, there is a shakeout in terms of competence, and you see it and I see it. The people who are not up to speed are being sorted out by guess whom? The consumer. The consumer is very smart. The consumer is not dealing with those account executives who they do not believe are on top of their game or really.
Bob,
but those that are good are becoming more in demand and are doing.
Bob, you just said those people who are not up to speed are being sorted out.
Are being sorted out.
Oh,
I'm sorry.
S-O-R-T-E-D.
Sorted out.
Okay.
They're losing out. I'm
I thought
sorry. Forgive my pronunciation.
Yeah, I thought you
Sorry.
meant S-O-U-G-H-T.
No,
Okay.
they're not being sought.
Uh-huh.
They're being sorted out.
I see. Okay, eliminated.
And they are being eliminated, and they're at the end of the business where they are not going to make it as top-notch professionals in the future.
I want to pick up a point, one of your points that you enumerated a minute ago. You made a comment that the products are going to have to be distinctive.
Right.
It may not be fair to use the analogy of the automobile industry, but in the automobile industry, increasingly, I think that Mercedes has an identification, Toyota's got an identification, Buick's got an identification. Yeah. The manufacturers have been forced to get into quality distinction. At least I see that as a consumer. I'm not sure that happens in our industry. In our industry, we have mutual fund as a mutual fund, other than perhaps that Magellan, the Peter Lynch. Bond fund is a bond fund.
I'm not so sure I said that we should, that people can really differentiate themselves by product. They have to decide what products they are going to represent that they're good at. And then they're going to have to seek out other suppliers of those products, and then they're going to have to couple that with the advice to the client to buy the right products that are for them. And that's where differentiation will come in. I think what you're talking about is the concept of market differentiation. And that is the marketing challenge for financial institutions in the years ahead. Why should I deal with company A versus company B? Why are they different? If they put themselves forward as being very good at mutual funds and very good at equities and very good at tax shelters, and they are, that's great. All the other products, fixed income or otherwise, they better go find somebody else who can help supply them and let them sell that array of services, some which they manufacture and some which they don't. The differentiation will come from how do they deliver to the consumer? And that's where, again, information, technology, and the role of advisors will come in making people, institutions, better or worse at what they do.
Carl?
Yeah, Bob used the word before, education. You know, and I think it's so right. The people who need these services must be educated. The proliferation of product and the derivative products, et cetera, have gotten a lot of people confused. And therefore, what we need are people in the industry, in the financial services industry, that understand and can convey and educate the client base on what these products are, what risk factors are involved, you know, suitability and so forth. And that is all part of the process of professionalism that is going to continue, in my opinion anyway, to weed out the lesser levels of quality in the industry, as the industry is going to have to weed itself out in terms of cost controls and so forth and so on.
I want to make an observation to you based on my work in the trenches day in, day out. In my opinion, the major brokerage firms, most of them, if not all of them, have a lot of good product. One of the major problems you have is when you go to the consumer, that subjectivity. The consumer themselves don't know exactly what fits, what is appropriate, what is inappropriate, what does product A do for me, what does product B do for me, and that educational job is a huge job. Now that's a one-on-one. That's between...
Well, Phil, that bears out this study. The study said that the consumer makes his decision to stay with the firm primarily based on the relationship with the person providing the direct service, the advice, the guidance, and that is the primary driver in that relationship. And there's no question that they look to that person to sort out those facts, and that the products are not a strong differentiating factor. The assumption they make is that the products that you're offering are equal. They do have questions about what's right for them, and the individual firms, banks, institutions, whoever is dealing with the consumer in the future is going to have to do a good job of explaining why it meets his need, because he's smart, he knows fundamentally what he's trying to accomplish, and he wants to walk away from that transaction feeling comfortable with the end result.
See, the discussion, I guess it raises and creates a lot of turmoil within me. All of us come from the era where we got into an industry where they told us, hey, do certain things, and first now you're going to have a public stock. You're going to be a member. You work for a company where you can own the stock.
Right.
In the old days, we owned stock, but it was private.
Right.
We bought it. We never knew if we could sell it. Okay. So we went public. Do the right thing, and our stock is will be like an IBM, hopefully. Mm-hmm. Well, we owned stock, and it went way up, and boy, we got to come up and. Now, the concern I had in terms of all this restructuring, I see real problems in terms of shareholder equity, in terms of the industry. These consolidations can wreak havoc in terms of ownership and equity for the shareholder. I know this is a shift to the agenda now. Now we're looking at the industry from the
Carl
viewpoint of an
touched on it
investor.
earlier when he talked about the risk orientation of the 1980s and the shift to a more conservative approach. When I grew up in the business, you never owned your own real estate. You never committed capital beyond what you needed to do. I believe in 1989, roughly 65% of the industry's revenues came from risk-oriented activities. Now that's as huge a shift as the one that took place from the individual to the institutional
And
investor.
by the way, that kicked those firms in the rear end.
Exactly. So what we're saying is the time has come to go back to that era where you get by on giving good advice, good information, providing good service, and operating for a fee on a fair basis.
We're talking about back to the fundamentals.
Well, that's right. It's back to basics, and the restructurings that I'm talking about, and I think Bob and yourself are talking about, I think it's all positive.
I do too.
Sure, it's disruptive to some people, but the fittest, like any other
will
situation,
survive and will grow.
survive.
Right.
And if we're talking about how does this thing look down the road, I think you're going to see the very strongest, the most competent, the most efficient, the best professional firms continue to survive, a number of very, very large quality organizations, and then you're going to have a number of boutique organizations that have specialized segments of the market that they want to hone in on and where their expertise, permits them to find a niche in the marketplace. In effect, all we're doing is going through the same cycle that, when I first started, in the sales end of the business was semiconductors in the early 60s,
Right.
Texas Instruments and so forth and General Instruments. The survivors were the quality companies who had the best products with the best marketing, the best service, and that's all that's happening in our industry, and it's not unhealthy.
I will say this, that I will predict that we won't see it for a while yet, but over the next 5 years, banks, regional and otherwise, will become effective competitors on the delivery of financial products and services. They will become much more effective than they have been. They will have to get rid of some of the problems they have today before they really focus on this. But I think you can look for much better competition from them in the latter half of this decade.
And on that same point, and I started to allude to this before, I think the ultimate may be to see banks, financial services firms, possibly insurance companies, all merging, because as the globalization of this industry becomes more and more
Right.
apparent and the competitiveness becomes more and more apparent, they're going to need these combined capabilities to service the consumer.
Yeah, we haven't gone into it very much, but the internationalization, we're talking about mutual funds. How is the businessman who is doing business outside the United States today, who's beginning to accumulate foreign currencies, how is he going to manage his money in the future? And who's going to advise him on whether or not to hold Deutschmarks or yen or any other currency that might exist 5 years from now when Europe is unified?
Bob, those are terrific questions. We'll have to look at them in greater length. I know we've opened up a lot of areas you'd like to hear about in greater depth. We've run out of time. Be with us again soon. Thanks and good night from the Money Corner.